Hello, everyone, and welcome to our ICGN seminar on the interaction of political and investment risk. I'm Norm Eisen, and I'm joined today by a fantastic lineup of panelists. And if you like what you hear today, we're going to have an even more extended version of this conversation at ICGN in London that I'll tell you all about when we finish, including processing your comments and questions on our assessment of the decline of democracy, the threats to democracy, and how democratic backsliding can be reversed. We're going to survey the scene globally. We'll look at events in the United States, attempt to prognosticate how that will impact institutional investors and all of the stakeholders who are implicated in our work. But we're also going to look at, because we have an all-star panel with a global view, look at events that are happening even as we speak in Europe, in South and Central America, and really around the globe, because the phenomenon of democracy's vicissitudes, its ups and downs, and the way that impacts the economy, finance, and so our stewardship and fiduciary responsibilities is not something that is confined to any one jurisdiction. I'd like to introduce our distinguished panelists who will help us grapple with this issue. I'm sorry to say that these questions have taken on an even sharper relevance since we scheduled this warm-up panel and the in-person one that we'll be having at ICGN in London because of developments in the United States that we'll talk about just over the past days, really, the past 5 days. 6 days, and even more rapidly accelerating events in France, but lessons drawn from past years all over the planet. I'm very pleased to welcome to the panel my colleagues, Stephen Davis of the Harvard Law School Program on Corporate Governance, of course, like our other panelists, a familiar face and an ICGN regular, Karina Litvack, the non-executive director on the board of Italian national power grid operator Terna SpA, a distinguished career on these topics. Sandra Guerra, the founder of Better Governance, a Brazilian-based corporate governance consultancy. And I want to get everybody ready in the best ICGN tradition for our polling questions. We are now going to do our very first polling question. And that is, you can see it popping on your screen. How would you describe the directional trend of political risk in the global capital market? And I'm going to make my choice in my mind because the host and the panelists can't vote. I think I may have tipped my hand already, friends. I'm going to ask all of our participants to cast their vote. Okay. And with that, we will get the results in the chat. You can find the results. Rising steeply, 57%, or moderately, wow. That is, by my count, 93% of you believe that it's rising either steeply or moderately, with a majority, 57%, rising steeply. I wish there were another category that could be like rising alarmingly, or I guess steeply captures it though. Professor Davis, will you kick us off, please?
Thank you so much, Norm. Appreciate that introduction. And as I think you felt, that was a pretty bracing result. I think it's a result that probably we might all agree with on this panel, but it's bracing. The thing about political risk, though, is that it's nothing new for investors. What is a characteristic, though, of investor behavior is that, for the most part, investments in the United States have considered political risk to be essentially risk-free. In the United States, political risk is considered, or has been considered, essentially zero. The problem with that is, I think we'll hear later, especially from Norm, is that political risk in the United States is now about as high as it's been since the US Civil War. And political risk in the United States is not like political risk elsewhere. Yes, investors think about political risk when it comes to other markets, but it's very specific when it comes to the United States for the obvious reasons. The United States is the world's largest capital market. It accounts for about a quarter of global GDP. It's 1/6 of all trade. And of course, the United States dollar is used for at least half of all cross-border loans. So the bottom line there is that if you're an investor, there's no ready exit. There's no ready alternative to the United States when things go wrong. And the fact is that there are a lot of warning signals about things going wrong. As I said, we'll hear shortly from Norm about this. But if we think about the capital market, the signals are clear. Fitch downgraded the United States' credit level in August of 2023, citing deteriorating governance standards. Moody's followed suit in November, lowering its rating outlook on the United States government from stable to negative. And again, citing governance dysfunction as a key factor. And then, as you'll perhaps have seen in January of this year, Eurasia Group, in its annual survey of global risk, named the United States itself as the greatest threat in the capital market. So it was in the context of these developments that Brookings and States United, Democracy Center came together with a variety of people, and we created a project called Capital and Constitution. And we brought together a number of mainly institutional investors. It was a set of off-the-record roundtables with the mission of trying to assemble evidence that capital has a vital stake in keeping US democracy healthy. So we had these roundtables. We had about 20 participants representing about 15 to 20 trillion US dollars. And we commissioned for evidence 2 papers, and we conducted a survey. And I'll just briefly mention what we came out with. So the first paper was called "Is Democracy Failing and Putting Our Economy at Risk?" And we had 2 Brookings authors, political scientists, who, in a word, answered, yes, it is putting our economy at risk. The second paper, which was released about a year ago, was by Princeton professor Lena Mosley, and it was titled "The Financial and Economic Dangers of Democratic Backsliding." And I'd encourage you to read both of the papers. We will, when I'm finished, we'll put links to these and also the other things I mentioned so that you can look at them yourself. But Lena Mosley's paper really talks about what are the costs of democratic backsliding to investors. And then we released our own survey. We did, Capital and Constitution did a survey on how investors are tackling or thinking about political risk, and the results were revealing. Some 90% of big institutional investors said that they believe threats to democracy in the United States are rising, but less than 30% of these same investors were confident that US public companies are equipped to manage that political risk. The second big finding was that 40% of investors surveyed typically do not consider political risk at all when deciding about investments in the United States, as I mentioned earlier. And by contrast, almost all take political risk into account when focused outside the US. And then finally, we found that more than 60% say that that they incorporate concerns about political risk into conversations with US portfolio company board directors and executives. Another 20% said that while they hadn't included that topic in agendas in the past, they're considering doing that now. And only 10% of the surveyed investors said they say nothing at all, include nothing at all about political risk in such engagements. So the bottom line, and I'll end with this, is that the project concluded that investors increasingly see that there is a fiduciary duty to take account of political risk in the US in furtherance of protecting financial interests of beneficiaries. Indeed, political risk in the United States might now be considered by some institutions to be a systemic risk akin to climate change. The good news is that there are things to be done about that. We'll talk about that shortly. Thank you, Norm.
Thank you, Stephen. And it's now time for our second polling question. And there you should see it on your screen. To what extent does your institution incorporate questions around political risk into engagement with corporate boards? And while you answer that question, I'm watching in the chat for that answer to pop. Just a reminder that there is a lot that can be done. And Stephen alluded to that. We're going to talk about that throughout the panel, because a strong toolkit for institutional investors, as all of you well know, has evolved over the years on a variety of issues, with climate change one, but by no means the only model. Okay, I'm now going to introduce, we got the answer. The poll number 2 has not considering, that's a small minority. Considering or currently is the vast majority, that is 82% of you. So that is a substantial number. And with that, I'm going to pivot over to our next panelist, my colleague Sandra Guerra, who's going to talk about political risk in the Brazilian context and more broadly, including the uncertainty it generates and the harm to Brazilian economy. It's a very important lesson from one of the most trusted observers of what happens the day, the year, and the decade after these political instabilities are introduced into a system, and the impacts on institutional investors and all of us who have economic or fiscal stakes, fiduciary or on behalf of shareholders. Sandra?
Thank you so much, Norm. Thanks for all the panelists. Well, let's talk about political risks in Brazil. And I'm going to highlight the uncertainty and the economic consequences. Well, first of all, recently, and particularly also in 2024, Brazil has been experiencing an outflow of foreign investments. And here, this outflow is driven by both global economic conditions and specific concerns about its political and regulatory environment. Of course, economical reasons are the main ones, but they are helped by these concerns. The perception is on Brazil is about a volatile and unpredictable market. And what is happening is that this uncertainty is pushing investors towards more stable alternatives. I'm going to cover here two examples of what is causing this situation. There are many others, but I'm going to bring two examples. First one is the elimination at some point of Lava Jato punishments. You may remember that Operation Lava Jato was initiated back in 2014, and it uncovered corruption involving top executives at Petrobras and numerous politicians, leading back then to high-profile prosecutions. What is happening is that there was overturning of several Lava Jato convictions, including the ones of the president, Luiz Inácio Lula da Silva. And this has raised concerns about judicial impartiality and political interference. The consequence of this is the undermine of trust in Brazil's judicial system. This rollback of Lava Jato has been seen as a step back in institutional transparency and accountability. And this, of course, increase the risk for investors wary of resurgent corruption. The consequence and the last consequence of this is the economic impact of this sort of thing. This political uncertainty I have mentioned can harm critical sectors, in particular because of the history, the oil industry, with important losses. Investor confidence diminishes as the perception of increased political risks grows, and potentially leading to a capital fly, as we are seeing, and reduce foreign direct investment. This is my first example. Let me switch to the second example, which is related to the state-owned company law. There was a suspension and a subsequent revalidation of the state-owned companies law during this administration, this president administration, with significant implications. This law, the suspension of the law allowed politicians on the boards of state-owned companies, and this raised concerns about regulatory stability and the influence of the government in corporate decisions. The possible political interference creates, of course, a perception of instability in the business environment. And investors, of course, witnessing this fact, became cautious due to the risk of this policy change affecting state-owned and private companies' performance and governance in Brazil. The continued political appointments during the suspension of the state-owned companies law underscored concerns about corporate governance and transparency. And this was crucial, this belief that there is corporate governance and transparency in this company is crucial, of course, for attracting and maintaining foreign investments. So this fact that I'm mentioning increased the risk aversion and demands for right returns to compensate the uncertainty. The conclusion, I conclude here to say that there's two facts: the elimination of Lava Jato-related punishment and easing of restrictions on implicated individuals, along with change to the state-owned companies law, exacerbate political risks in Brazil. And we are going to talk later on about what investors could and may do about this. Thank you.
Thank you, Sandra. And now Karina is going to turn to that question, because we never like to present a problem without a solution. And there's no question. Stephen, what was that cartoon you just read me when we were in the prep session for this seminar today? What was the punchline?
Yeah, someone, there's a picture of a woman who's being interrupted, and she says, "No, don't interrupt me. I'm watching the season finale of the United States."
It's not that bad. This is not the season finale of the United States. There are a set of challenges that we need to deal with. I'll talk about the US situation politically, economically, finance, and for institutional investors in my section at the end. But the challenges are real. We've seen ups and downs. We've seen places in Europe where democracy has receded, like Poland, and then reversing the Czech Republic, where I was US ambassador, and then reversing democracy comes back. And we study that at State Democracy Defenders Action, which is my US and global nonprofit hosting this event. We will also be hosting the event at ICGN in London, where we're one of the platinum sponsors, calling attention. We exist to call attention to these threats, but also to call attention to the solutions. And for that, Karina is going to talk about her experience. She'll offer the Europe lens a little bit, but also what institutional investors and others can do. Karina?
Thank you. Yes. So sorry for the croaky voice. Look, I really do want to pull this to what we do about it, because there's no question that investors have been looking at these issues forever. I mean, maybe not so much in the US, because for the reasons you've just laid out, it's considered to be, the the center of the universe. But certainly, I mean, if you think of the 2008 financial crisis and the meltdown in Greece and the ripples that it had across the market. I mean, I serve on Italian boards and have done for the last 10 years. And the concept of lo spread, the spread between Italian government bonds and German government bonds, is something that your average man in the street talks about, right? So these are the types of things that have an influence on people's perceptions of the market, all the way down to the retail investor. What happens is that they influence what's happening in terms of geopolitical risk or political risk within an individual country is immediately interpreted in terms of the impact it will have on national debt, right? And that the impact that in turn will have on equity markets. So far so good in terms of the sophistication of investors in understanding the implications of what are perhaps, amorphous political risks and what that means in dollars and cents and euros and cents and so forth. Where I personally get frustrated and where I hope that we can make some progress today is in what we do about it, because investors have historically been reactive. I mean, when I was an investor, we would look at where we shift money from one market into another and then back again, as things seem to, ebb and flow in terms of levels of perceived risk. And likewise, if you're a company, and I'm thinking about this conversation in the boardroom, the conversation will be, we're gonna dial down our investments in Turkey right now because inflation is out of control. Why is inflation out of control? Because there's a populist government that is interfering with the central bank. I mean, all of these things are understood, but the reaction, whether you're an investor or a corporate entity, is to just pull back or invest more. It's not to use your voice to actually engage with the problem. And my worry is that that is no longer enough. If you look back to when Donald Trump was elected in 2016, and one of the very first moves he made, some of you will remember the so-called Muslim travel ban, where people coming from certain countries were simply not allowed in, even if they had a business reason to enter the United States. PhD students, engineering students who came from these countries were denied the right to stay past their studies. Guess what? They all went to Canada. Great news for Canada. But that prompted the American Manufacturers Association to do something that had not been done before, which is to put out a very mildly worded press statement saying the AMA favors free access to talent. So I'm paraphrasing, but something that very gently kind of called out the fact that restricting people's ability to enter the United States was bad for business. And that teeny little move to take a stand, however meek and frankly, probably not that noticed it may have been, was to my mind an encouraging sign that this is what businesses can do. Now, we know that businesses, and we saw this with Brexit in the UK, businesses were afraid of speaking out for fear of retaliation from government officials. We see that in the United States. We see that with the so-called ESG backlash and investment managers who are toning down their positions on ESG engagement for fear that they're going to be suddenly hauled out in front of the courts or in front of Congress. And so one can understand why companies would be spooked at the thought of raising their voice. But that tells you that we've been too complacent. The fact that we have got to this point already is the problem. That doesn't mean that we're out of solutions. We can come together and work through trade associations where we are, obviously, we have strength in numbers and we are better protected against retaliation. But really, raise our voice we must, because failure to do so means that we all pick up the tab for this. And we pick up the tab for this in terms of, as the AMA had pointed out, restricted access to talent. We've seen this in the UK with Brexit, where, the hospitality industry cannot get staff, the healthcare industry cannot get staff, nor the elder care, nor the construction business, food processing, also, and we have the same problem in the United States, as anyone on this call will know, because of restrictions in immigration. And by the way, the problem is the same in France. I was just hearing today that the problem is the same in Romania. So even places where we may not necessarily assume that there are labor shortages, there are. And these labor shortages are created by populistic policies that are bad for business. So we as investors, we as businesses have a very clear interest in taking a stand in order to, press our businesses to do better. And I wanted to share one really interesting point that I heard yesterday, because I'm glued to the French elections at the moment since I'm a voter in France. And one of the points that the Italian commentator made was that Giorgia Meloni, who, as many of you will know, is prime minister from the ultra openly open, shall we say, followers of Mussolini, and who now run the government in Italy, are very conscious of the impact of financial actors on Italy's attractiveness to foreign investors. And that has been the one only curb on that government, is the fact that lo spread, will suffer if she goes overboard in her policies to destabilize institutions. Now, is that enough? Certainly not, but it's just interesting that even just these shifts of capital in and out do act to some degree as a brake. They haven't by any means contained what that government has done, but it's indicative of just what levers we do have if we choose to use them. So I want to just turn briefly to what implications that has for us in the boardroom. I'm curious to hear what Sandra can share with us because she too has been in that position. But I myself have been, obviously, when the war in Ukraine was declared, being in the board of an oil and gas company, geopolitical risk was at the heart of everything we were doing all of a sudden. I mean, literally overnight, it colored so many decisions we needed to make. And so we were forced into a position of having to make some decisions. And I won't hide that my board colleagues were very, very uncomfortable with having to basically make a choice between what is the right thing to do and what is the safe thing to do. Recently, I was at a seminar with board directors where the subject of geopolitics was being discussed, and one director spoke out and completely unchallenged from anyone in the room said, "Let me remind everybody that our job is to maximize shareholder value. So if there are problems in the wider national or international political climate, it's not for us to get involved." Zero challenge to that view. And yet failure to act means, as I said earlier, we pay the price. And a final example I want to share with you, a friend of mine is on the board of a major European board of directors. This friend pointed out that the French elections were causing instability in the French debt markets, in the value of the euro. And shouldn't the bank be modeling this and putting in place some risk mitigation measures? The idea was completely dismissed. And the comment that came back, and please buckle your seatbelts, was, "Well, you would say that, you're Jewish." And I'll stop there.
Thank you, Karina, for that sobering, but also powerful analysis of what can be done. I'm now going to offer some very brief remarks, and Stephen Davis will take us home by sharing the stewardship toolkit that institutional investors can use, with a particular focus, just because it's so much in the news today, with even as we speak on this seminar, news zooming around about continued twists and turns in the U.S. Political scene, new developments. Stephen will bring us home, and then I'll offer a few moments of reflection, and then we'll have one last polling question after Stephen shares the toolkit. I want to focus on the U.S. autocratic risk as it exists today, July 3rd. I'll begin by telling you, friends, that the notes that I made for this talk 10 days ago had to be torn up and rewritten 3 times over the past 5 days because of the gyrating level of political risk. And if this headline that I'm reading about possible shifts, if I were to give it tomorrow, I probably would have to be restructured again. So as we stand today on July 3rd, we foresaw this turbulence, I will say. Our panelists, and in particular, Stephen and I have worked with a group of institutional investors and others to study that we might be at this moment where we're asking the question, are the wheels coming off the bus? If we haven't already, we'll send you the link to the first paper, the Brookings paper by Kmark and Galston, Assessing the State of American Democracy, warning that this moment might come, is from more than 2 years ago. And does the backsliding of American democracy constitute a systemic risk? As Stephen noted, we do think that even when the paper was written, it did constitute one. It has only become more profound, and it impacts fiduciary duties. And we will send you that or resend you that link. We updated that with a more recent paper by the scholar of economy and political science and democracy, the Princeton professor Lena Mosley, articulating the sharpening risk. Again, we're sending you that link, and the erosion of democratic practices and norms in the United States pose risks for investors. Those risks have considerably sharpened because one of the major political party candidates in the United States and his allies have literally issued hundreds of threats of autocracy should he and they take over on January 20th, 2025. We track those in the third link we're sending so you can see the full panoply. It's startling when you look at it in context, the American Autocracy Threat Tracker. We include in there the threats that political opponents, which Mr. Trump has made, that he will prosecute his political opponents simply for policy differences or no reason at all. That the new Supreme Court decision that has been such headline news in the United States, but around the world, that authorizes him. I know this is shocking. It's impossible to believe. I can't believe I'm saying it. I worked on Donald Trump's presidential transition. This is not I'm not, as we have this term in the United States, never Trumper. That's not me. I know him. I've dined with him. I briefly assisted him with his transition to the presidency in the United States before I became concerned about some of these autocratic tendencies. The Supreme Court opinion says that presidents are absolutely immune for whatever they do in their official duties. That means that if Donald Trump were to order SEAL Team 6, order military authorities, and we've seen this in some of the international examples, never in the United States, if he were to order the military authorities to kill, to murder his political opponents, he could not be prosecuted. It is so shocking. It reflects such a debasement of the Supreme Court in the United States. That alone enhances the political risk. And he's threatened revenge, as you'll see, dozens and dozens of times, mass arrests and roundups, establishing concentration camps for undocumented migrants in our country, the unclear fate of those who have been here, born here, without proper documentation. Some numbers are over 10 million, and a variety of other autocratic threats. We don't know how much or how little he'll do this. But if you look in that American Autocracy Threat Tracker, if you look in the letter of the Nobel, over a dozen Nobel Prize-winning economists that we include in there, we'll send you that link as well. It will precipitate a economic collapse if these promises, or even part of these promises, are followed through in the United States. And I would direct you to, we have a detailed analysis, one of the most detailed analysis, collecting all of the risk factors to the economy, and it is section 22, chapter 22 of the American Autocracy Threat Tracker. We include the connections between democracies and the stability and predictability. You do get ups and downs in growth, even in dictatorships and autocracies, but democracies are strongly correlated, according to the VDEM Institute, with stability and predictability in growth that minimizes risks and has made the United States an important, I don't know if I agree that it's the center of the universe, but certainly an important critical pillar, the pillar of the global financial structures. Autocratic regimes, negative economic factors, high inflation, lagging GDP, brain drain, drastic economic ups and downs and declines. That's what you're going to see in the United States. Economic ability, black swan risk with some of these autocratic actions like sending murder squads, which the Supreme Court has authorized, I'm sorry to tell you. Runaway inflation, which former Labor Secretary Larry Summers, Treasury Secretary Larry Summers, Mark Zandi, the chief economist of Moody's Analytics, and so many others, the effects of protectionism that Trump is threatening, including the enhanced China and other tariffs, threats against Europe, attacking the independence of the Fed, devaluing the dollar, and on and on and on. It's not only a nightmare for democracy, it's a potential economic nightmare. Now, will Donald Trump send out death squads on day one? Absolutely not. The lessons of history show us that even in the most extreme autocratic regimes, there's a gradual ramp, boiling the frog, as the phrase goes. But what he will do is test the boundaries, and it is an open question whether we go the way of Orban or Erdogan, where a shrewd leader returns to power and is able to gradually transition a democracy to an autocracy. Whether we go the way of Poland, where autocrats take over, attempt to do it, but are unable to hang on to political power because they insufficiently degrade the political institutions to insulate themselves permanently. Whether we go the way of Putin's Russia, where Putin did degrade those institutions. I was with Obama in Prague when we met with Putin's predecessor to sign START 2. We had high hopes still in 2010, still when we were at Prague Castle together, for the trajectory of Russian democracy. It was not meant to be. Or even darker, there are even darker historical examples. The United States has great resilience, however, and there's things institutional investors can do to protect existing investments, but also to prevent this nightmarish dystopia or to limit these events by using the full institutional investor toolkit. I'm going to turn to Stephen to close us out. We'll do our last polling question. We've gone a little long, but we do have time for questions from all of you. I see there's already questions in the Q&A, and we will do an efficient round of questioning. Stephen?
Thank you, Norm. I'll be very brief. One quick comment. The poll results from earlier in this session very much echoed the results that we got from our survey. So that's, I think that's a validating set of answers. Just as an overall comment, the United States is in effect like an index fund, or investors have to treat the United States like they would in an index fund. You can't exit easily, or maybe you cannot exit at all. And so if you can't exit an index fund, you have to use tools of stewardship to try to enhance value and reduce risk. The same thing goes with the United States. You can't really leave it. So you have to figure out how to use the tools available. So I'm going to just list off 7 options that we developed through the Capital and Constitution Project and through other investors. First, you add political risk to the set of factors that you assess, both in terms of asset allocation and stewardship decisions. So it's just part of the architecture of stewardship. Secondly, you could issue, and this is a spectrum of options, you could issue an explicit statement that political risk resulting from democratic erosion in the United States elevates the probabilities of domestic political disorder and therefore market instability, and therefore posing a material risk to client investment. So that's the second one, issuing an explicit statement. Third, an investor could ask board directors and executives at portfolio companies whether they consider U.S. political risk relevant to their business operation. And you could sort of incorporate those answers in how you proceed. Fourth would be conveying support for business leaders who advocate electoral integrity and respect for the rule of law. Fifth, an investor could advocate full disclosure of corporate lobbying expenditures as a means of ensuring that lobbying is consistent with corporate strategy and political risk mitigation objectives. Sixth, one could encourage collective bodies, such as the ICGN, to highlight political risk as we are today, and we will at the London conference, and even to issue political guidance on those issues. And then finally, if there are frameworks of pass-through voting or expressions of wish, investors could offer client investors voting options that address political risk, just as they now do for climate and other large risks. So those are the seven big factors, items in the stewardship toolkit that one could use to mitigate political risk in the United States and elsewhere.
Thank you, Stephen. And with that, we're going to go to our last poll, and then we're going to answer your questions. You can see on your screen, what expectations, if any, do you think investment institutions should have of the directors who serve on the boards of their portfolio companies? And you have your four choices. Take your time, but not too much time, to answer the question. We'll get you the poll answer. It'll pop up on all of our screens. And while we do that, I'm going to start the Q&A, going back to my screen here and going into the Q&A. The first question is, how do we reconcile the findings? Everybody can see this in your Q&A box. That democracy is a threat. The top business leaders are supporting Trump. How do we reconcile that? And there's some presumptions, certain policy actions could benefit them. But does this not risk ignoring the long-term trends? I will, let's see if, yes, our answer have popped, and then we'll answer how we deal with that tension in the business community. So the greater majority is that it does need to be monitored, either in a low profile. It's so interesting. This has been the pattern on all of our questions. There's probably a certain amount of self-selection in our approximately 80 participants who have joined us today, a wonderful turnout from all over the world, I should say. And you have...
I'm happy to
yes.
answer the first question if you like.
Yes, with a supermajority saying risk needs to be taken account of. Stephen, why is it that, is the premise right, first of all?
That's what I was going to say.
Go ahead.
Yeah, well, first of all, I just want to make it clear that we're really not talking about partisan issues here, and you know, Trump or Biden. or Starmer and whatever. We're not. This is really about political risk and about the rule of law, respect for the rule of law. And it could be that those threats come from the right, or sometimes they come from the left. But from an investor point of view, it's really about risk and the stability of markets. So that's just an overall point. Second point, the premise, I think, is wrong. You may have seen new data from Yale School of Management the other day that showed that at that time, not a single Fortune 500 company CEO had donated to the Trump campaign. So we see that there's some media out there, but for the most part, companies are playing it very safe, as far as I could tell. That's not necessarily good news, because what we did see after January 6, 2021, was that there were a series of CEOs that did step out and say that democracy is at risk. We need to maintain our guardrails. We need to maintain access to the vote and the integrity of elections. The problem with that is that investors were essentially silent in terms of backing those CEO statements. So this is what our job is today, to recognize, as Karina was saying earlier, that if we're silent, we're going to pay the price. Investors are going to pay the price. If democracy slides, there is a direct impact on the values and value of client investors over time.
Anybody else want to weigh in on the CEO anomaly? Although my answer would have been the same as Stephen's, I'm going to provide a slightly contrarian two-sentence answer. Karina, Sandra, do you want to add anything to this? You're on mute, Karina. Still on mute. If necessary, I can read your mind and say what you would. No, I'll offer my quick contrarian view. You have seen that although Stephen is right that it's the weakest GOP support, or the weakest support for a GOP candidate in modern American history, you have seen the like Jamie Dimon, the endorsement of a permission structure where, there's pluses and minuses. There's been bad things about Biden. There's good things that happened in the first Trump administration. It falls far short of embracing, but even since that Diamond statement, there's been such sharp deterioration. And with the endorsement of death squads now by the Supreme Court, I think the landscape has shifted dramatically. So it's a call to action, and not in a partisan way at all. I'm hosting a summit when I get back from ICGN the following week. In fact, if there are institutional investors or others who want to join, predominantly Republicans, predominantly conservatives, American autocracy, a warning and a response in New York City at NYU. Dozens and dozens of our most prominent American conservatives are speaking from every administration since the Reagan administration about the recent deterioration. So since you've seen some of those questions by Diamond and others, the situation has become considerably worse. I think we are going to see institutional investor engagement, and you're going to see bolder corporate action. It will, however, be buffered by the fear factor that what happens if we do get that regime in 2025? How do I protect myself? I think that is very short-sighted given what happens to economy and financial and institutional investor positions in a dictatorship. So I'm Karina. No, you're still on mute. Unless one of us can, I'm going to go back to the questions. Sandra, do you think that investors could play a role in encouraging the Brazilian state to resume the fight against corruption?
Thank you, Norm. I mean, I understand that investors have limited resource to act. So the question is about, engaging with the Brazilian state. I think it would be easier and more practical to investors to engage with companies in Brazil, particularly the state-owned companies, because of course, these companies need the resource coming from, international capital. As I was saying, the capital flew from Brazil, importantly, recently, and they need to attract the capital back. So, I mean, I always think, follow the money. So if investors, instead of going out of Brazil, because we have very important assets that are really undervalued because of the many reasons that I mentioned and because of other economical factors. So I think it would be a matter of investors engaging with state-owned companies in regard to what is important to be done, the risks, and being vocal. That is not about only to creating value to investors. Investors may present a rationale that it's good for the country, for all stakeholders, that this value will be created and they will be supporting investing in those companies. And also, they should be interacting with non-state-owned companies, with corporations and stuff, because I would be afraid that the top of political risks is not in the agenda properly of Brazilian boards. I would bet on that. So I think that being vocal, interacting, engaging with the board of directors of Brazilian companies would be the way to go to investors that would benefit from creating value for very important Brazilian assets.
We had a couple of other Brazil questions and a democracy and technology question in the chat, but I feel like we managed to cover the global north and the global south in the questions, including a very smart question about FDI from our friend George Dallas. Friends, we're reaching the end of our hour. I just want to thank all of the, at one point, it got up to, I think, almost 100 participants. I want to thank everybody who was on. I want to invite everybody. London, we're on the agenda for London for July 17th. That's Wednesday, July 17th at 2 p.m. Our friend David Pitt Watson will join Sandra and Karina and myself, plus an additional surprise guest on that panel to talk about these issues. We're very grateful. Thanks for joining us, friends. See you in London. Much more to come. Thank you. Thank you.